All right, Adam and Joe, I think we're ready to get started.
Fantastic. So welcome everyone to tonight's webinar, Maximizing the Real Estate Tax Benefits, Part 1. For those of you who are, if this is your first webinar with us, welcome, excited to have you. And if you've been with us before, welcome back. A reminder, we will be taking questions at the end of this webinar. However, along the way, at any time you have a question, please go ahead and at the bottom of your screen, you'll see a box that says Q&A. Please go ahead and type your question into the Q&A box so we can get to it at the very end of this presentation. So at any time, do that. And again, make sure though it's the Q&A box, not the chat box. So we are just required to flash these on our screen, our confidentiality disclaimer. Don't worry, not going to read it verbatim. Same for our financial disclaimer. Just need to show it on the screen, but we're not going to read it verbatim either. Now, Break of Day Capital, to those of you who are new to us, Break of Day Capital, what we do is we acquire underperforming multifamily properties in high growth markets that are seeing not just population growth, but good wage growth and economic growth. So we're specifically focused on the Southwest. Once we acquire these properties, we implement strong repositioning strategies and best-in-class asset management to maximize the values for all of our shareholders. In 2023, we were recognized by the American Apartment Owners Association, the AAOA, which has over 140,000 members nationwide, as the best real estate syndication company of 2022. Inc. magazine recognized us as the 671st fastest growing private company in the US and 25th fastest growing real estate company in 2023. We've acquired over 1,600 units with a total value of $280 million in real estate transactions. And of the deals we've done, 4 have gone full cycle. We've acquired them, renovated, stabilized, and sold. In all 4 of those deals, we've exceeded our projected returns. Now, asset management expertise. So many operators are really focused on the capital raising, and they talk about the acquisition front, and they really overlook the asset management part. Not us. Asset management is something that we are strong believers in and really focused on. As you can see at the bottom of the screen in bold, for 9 consecutive deals, we've been able to boost the net operating income, the bottom line, 40% within the first 12 months of operation. And this is due entirely to our emphasis on asset management. As you can see on the right side of our screen, Gary Lipsky has written a best-selling book called Best in Class. If you have not read it yet, I highly recommend you do. You can order the book on our webpage. Just go to our webpage, click on it, enter your information, and the book is free. You just have to pay for shipping. And for those of you who love podcasts like myself, if you have an iPhone, I highly recommend you just type in under the iPod app, Gary Lipsky, Real Estate Investor Podcast, and you can subscribe to his podcast. He's had over 200 episodes. My colleague Joe Feng and I both have been guests on this podcast before. Now, mission. Now, often I find when people are doing their due diligence, they often sort of glance at the mission statement versus really diving into it and finding out what the company really believes in. Our mission statement is to provide investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while improving the quality of life and community for our residents. A win-win situation for everybody. Our core values are integrity, transparency, communication, diligence, and Kaizen. Kaizen's the one term there that not everybody's really familiar with, but it's a Japanese business philosophy of continual improvement, something that we always strive to do. Now, Break a Day Capital's team, I highly recommend you go to our webpage and really look at everybody's bio on it. I'm a big believer in that phrase that you're the average of the 5 people you spend the most amount of time with. And I've worked in numerous places and can tell you I've never been as proud to be part of this team than I am at Break of Day Capital. On the lower left, you can see my picture. I'm the investor relations manager at Break of Day Capital. And just background about myself, I spent over 20 years on Wall Street. I was on the sell side, covering mutual funds, hedge funds, pitching them ideas and trading strategies. When I left Wall Street, I moved to Arizona about 8 years ago, started a small business, got into real estate, and first met our CEO, Gary Lipsky, 4 years ago when I was a multifamily realtor. I've done transactions all throughout the state and joined Break of Day Capital last October. My colleague Joe Feng is joining us this evening. He's our Director of Investor Relations. Like myself, he comes from Wall Street, but he was on the other end of the phone. He was actually running money. He worked at a New York-based hedge fund and Los Angeles-based asset manager. Interesting fact about Joe Feng is he's invested in over 60 commercial real estate syndications and 6 with Break of Day Capital. Sean Conchilera, he's our Director of Operations, and he is a former tech executive, specifically worked at Google Alphabet for YouTube. And he has been real estate investing for over 20 years. And he is going to be our moderator tonight. So with that, I'm going to turn it over to Sean to take over from here.
Awesome. Thank you, Adam, and good to be here with you as well, Joe. I'm really excited to be on this call today. We have close to 100 attendees on this call, and this is a really fun and exciting topic because it's something that I think every person on this call can actually benefit from at some point, if not, immediately, just taking these strategies and applying them practically. So I think the other point here is real estate offers depreciation tax benefits, which most other investments do not. And that's what makes this really unique and a really important discussion to have today. We have time again, as Adam mentioned, at the end for Q&A. So feel free to just drop in your questions, and as they add up, we'll address them towards the end and make sure we try to get to every question. So with that, I'll go ahead and we'll go ahead and kick it off. So I think the first thing we wanted to really cover with you all are really the basics on. So when we talk about the basics, the first thing that comes up is what is depreciation? So with that, I want to make this a little bit interactive, make it a little fun for everyone. So we have a pop quiz for you all, and we want to see if we can actually get this going. Okay, so I guess Lauren and Adam, these are the people on the back end. I guess because we actually ran through these questions, they're actually not pulling up at this time. We actually ran through them, and I think we actually triggered these questions to be kind of launched. But the question for you all is, do you know what depreciation is? And if you can answer that question, that would be, think about what that is. And I will go ahead and read a couple of questions to you throughout this process, just to see if you guys have an understanding or background of it. And if you don't, that's okay. We're going to dive into it anyways. So with that, I'm going to hand the pop quiz didn't actually work because it actually didn't trigger. So that's okay. We don't have to worry about it. But I'm going to hand it over to Joe, who's actually going to jump into this and really give us the nuts and bolts of what depreciation is. So with that, Joe, I'm going to hand it over to you.
Thanks, Adam. Thanks, Sean. Appreciate being with you guys here today. Before we start, we're going to start with the most basic definition of what depreciation is. I've been investing for a long time, and I feel like this part of real estate investing is probably one of the most underappreciated aspect of it. You see what I did there? Well, okay, here's the definition. The IRS allows us to take a non-cash expense. We get to write off against our income for the normal wear and tear of the rental properties that we own and manage. And I really want to point out this nuanced point here is that, when you spend money, when you spend cash out of pocket for a new roof or tiles or countertops, that's that costs money. It's money coming out of your pocket. So it is a true expense, right? But depreciation is also an expense, but it doesn't come out of your pocket and you don't actually pay for it. And this is one of the best things because you can actually expense something that you don't have to pay for. And yeah, it's probably one of the most powerful things in real estate. And so, okay, great. What's so big deal about it? Well, it is a write-off. It is a passive loss, and we're going to use those words interchangeably tonight. But with that, you can actually write off. You can actually offset against a variety of passive incomes and gains. Uh, Generally speaking, passive incomes and gains are incomes that you receive from doing very little. Okay. And one of the primary passive incomes is from real estate rental, uh, as well as real estate syndications, and then even things like interest from savings accounts and CDs, or even bonds. But the main point here that you should remember is that this is a really great way to reduce your tax bill.
Got it. Okay, so Joe, again, just so the audience kind of understands this, so where can I get access to this depreciation? So what are the ways to create depreciation? Can we go through some like specific examples?
Yeah, I mean, there's a lot of investment opportunities out there. Most people are familiar with, investing in ETFs and mutual funds, bonds, uh, but hedge funds, etc. But there aren't that many investments that actually give you depreciation. And one of the primary ways that you can get depreciation is actually through real estate. Now, there's a couple other investments out there that will give you some depreciation. Oil and gas comes to mind, maybe ATM machines, but those things will carry different risk profiles. But generally speaking, real estate is a go-to asset class uh, to receive depreciation.
Got it. So I feel the key takeaway here is depreciation can be used to offset passive income. Passive income is anything like rental properties. And when we say rental properties, we're talking about short-term rental properties, midterm rental properties. I know it's a new thing, the terminology midterm, people who are just renting out for 3 to 5 months. It's a very popular thing with nurses and people in the medical field. And then there's long-term rentals, which is the most common. So all of these are considered passive in terms of rental properties. Then you spoke about real estate syndications, similar to what Break of Day Capital offers. We have opportunities to invest in syndications. There's a ton of other private equity firms who offer, real estate syndications. Real estate funds, we have a couple of funds in our offerings as well. High yield savings, dividends, and stocks. Dividend stocks are examples. Awesome. So, and again, the key takeaway here is the goal here is to reduce your tax bill by depreciation, using depreciation to offset your passive income. And that's really what we're trying to get to. And we're going to dive into that more and get into more examples. All right, great. So let's move on. Let's see here. So the next topic that we have for this group is, okay, so we've heard about depreciation being used to offset active income like W-2 or 1099. Can it be used to offset active income as well? So right now, Joe, you just spoke about using depreciation to offset passive income. But what about active income like a W-2 or a 1099, which, probably most of us here are earning, from one of these, items. So I just want to give the audience a chance to think about if they understand this concept or not. And with that, I'm going to hand this one over to Adam, who's going to talk about this in more detail.
Yeah, Sean, when I speak to investors, when I talk about depreciation, usually one of the first questions that often always comes up immediately is, wow, this depreciation is fantastic. I love it, but can I use it to offset my active income, my W-2, my 1099? And immediately my follow-up question to them is, what do you do for a living? Now, unfortunately, for the vast majority of people out there, the answer is no. You cannot use it unless you are a real estate professional, or as we use the acronyms REP or REP. Um, with it, they're the one profession that actually can use depreciation to offset their active income with that. So it's important to understand that in general, this passive income, this passive losses, it cannot be used for, unless you're a rep. You cannot be used for your W-2 1099, and also a lot of your stock money you get from the stock market. If you sell a stock, your dividends, mutual funds, um, overall. And for those of you who are joining us tonight who are real estate professionals, we're going to dive into this in our next webinar in 2 weeks. We're going to devote specifically to real estate professionals, how they can benefit from the tax laws. But even though only real estate professionals can use the passive losses to offset their W-2 1099 income, what's important to remember, though, is depreciation can still be used to offset all your passive income, which can be a major benefit, especially when you invest in real estate. So I think it's. I know that there's always grumblings when people talk about this, saying, "Well, I'm not a real estate rep." It's like, time out. Wait a minute. This is still a huge benefit to you, and we can dive into how you can use this to benefit to lower your tax rate with your current investments in the future as well.
Awesome, Adam. And I think if I'm sitting in the audience, I'm thinking, okay, great. If I own a rental property, if I'm doing something in real estate already that's offering me a passive income, this is very exciting. I'm going to be able to use depreciation to offset this passive income. But for those people who don't have any passive income streams, they might be sitting there thinking, oh crap, this is really going to be useless for me. But that's not necessarily true. What we're trying to educate people on is, if you already have some investments out there, and we're going to dive into this, we're going to get into this. If you can figure out how to create a passive income stream, you can actually then take advantage of these strategies. So if you're already investing a couple $100,000 in something, and you diversify a little bit out of stocks and you invest some into some type of a passive income opportunity, whether it's into a rental property or a real estate syndication, you've immediately created a passive income stream where now you can really offset a lot of those taxes and gains that you'll see from that income. And that's really what we're trying to educate people on, how to create those opportunities for themselves and not just be limited to stocks and bonds and ETFs and stuff that don't give you these benefits. All right, so I'm going to jump to the next topic. And this is about, so, we talked a little bit about depreciation, and now there's this concept of accelerated depreciation using something called cost segregation. Joe, I'm going to give this one to you. Can you explain what cost segregation is and how does it accelerate depreciation?
Yep. Yeah, so just to give the audience a little bit of warning, we're gonna dive a little bit deeper when it talking about using the depreciation benefits. But I think at the end of the presentation, I think you'll find a lot of value out of this. So how do we account for depreciation, right? The IRS allows us to take a standardized, they call it a straight line depreciation schedule. And by way of example, a residential property can be depreciated over a useful life of 27.5 years. I have no idea where that came from. It sounds really arbitrary to me because I've seen buildings, been around for hundreds of years and stuff that don't stand up after 20. So I don't know where they came up with this number. But if you were to just take a standardized deduction, depreciation allowance over 27 and a half years, you can write off somewhere, between 3 to 4% of the total amount of depreciation that's available to that property. And it's based on the improvement of the property, not the land. Remember, we can't depreciate land. Land's not depreciable. but the improvements on the land is depreciable. And so you can write off, like 3.6% per year. Um, and you can see, like on $100,000 in depreciable amount, you can take off, the 3,600. Whereas there's a way where you can accelerate that depreciation. And one of the best ways to do that, and any proper, real estate operator would do this, is that they hire a cost segregation engineer and basically perform a study on the asset. And what they do is they come in and they assess the improvements and basically recategorize all the different components into appropriate um, depreciation schedule that's even shorter than the 27 and a half years. So not everything lasts 27 and a half years, in real estate, right? The components. Maybe the paint only lasts 5 years. Maybe the roof only lasts, 15. Maybe the fence only lasts 10, but they have like a menu itemized menu where they can reappropriate different components into shorter schedules. And once you do all that, you're basically able to accelerate the depreciation. You're able to take more, you can write off more upfront. You don't get uh um a higher total, you just get more of it. You get it sooner. Okay. So that's what we mean by accelerated. And so what does that mean numbers wise? Well, if you did a cost segregation study, and there's no reason why you shouldn't, um, you could potentially see up to 35% of the total depreciable amount uh, you being able to be used in year one, within the first year, versus the 3.6% that you could take if you were just using a simple straight line. So you can see that just using a cost segregation study alone, you can 10x the potential depreciation the depreciation expense in just the first year.
Awesome. Thanks, Joe. So I think again, your key takeaway here is instead of just getting the usual 3 to 4% that's spread across 27 and a half years, do a cost segregation study analysis on your rental properties. We do it on our syndications all the time. That's a standard practice, in multifamily large syndication deals. And instead of just getting that 3 to 4% depreciation, now you're looking at 30 to 35% depreciation that you can take in year one to offset your gains. And that's a huge chunk of savings. I mean, when you do the math, depending on how much you're earning. And it depends on each situation, but wow. Okay. So let's move on to the next topic. So it gets even more intense. So there's something called bonus depreciation, which is the accelerated depreciation we talked about, but supercharging that even more. So, I'll give this to, just to kind of rotate around. Adam, I'll give this to you. Can you help simplify for our audience what bonus depreciation is and how that works?
Sure, absolutely. In 2017, Congress passed a law that included bonus depreciation. So what this allowed owners of multifamily real estate to do is come in there as Joe before talked about, cost segregation engineer to really analyze the property, and all items that had a less than a 15-year depreciation schedule, you could clump all these together and write off all the depreciation in year one. So as we say in paragraph 2, you could have written off 100% of your investment year one when bonus depreciation was introduced. Now, the law it's scheduled to go out. It's been decreased in the last couple of years. In 2023, the amount of bonus depreciation you could take was reduced to 80%, and in 2024 it's 60%. But even at that number, that is a massive number. So think about it in this term, that if you were to invest $100,000 into a syndication and there was $60,000 of bonus depreciation, you would get $60,000 of passive losses to offset any passive income gains you're receiving. And also bonus depreciation, it's not a use it or lose it like the first year. What you don't use, you can carry to other year, down the road as well. So it's a huge benefit that's really been a great benefit to people who invest in multifamily syndications.
Got it. And I've been hearing rumblings, Adam and Joe, about Congress looking to reinstate this bonus depreciation back to 100%. So instead of going down from 100 to 80 to 60 and then kind of dropping off to something, they're looking to reinstate this back to 100%. Have you guys heard anything about that?
I have. I mean, I don't think it's likely going to happen this year, but there's definitely talk out there that it could go back possibly in 2025. Again, we'll see what happens, but I think where the optimism comes from is, in this hyper politicized environment we live in right now, this is not a blue state, red state divide. This is something that certainly would benefit all 50 states would benefit from this. All 50 states have multifamily real estate that people want to invest in. So this hopefully would be something that everybody can come to agreement on, but we'll see.
Joe, you want to add anything? Thanks, Adam.
No, that's perfect. Yeah, it's a nonpartisan issue, and both sides own a lot of real estate, so everybody benefits.
Yep. Cool. All right. Thanks, guys. All right. So, Joe, Adam just defined, bonus depreciation. Let's walk through a simple strategy for our audience so they have clear steps on how to take advantage of this bonus depreciation, the strategies that we're talking about.
Okay, so the name of the game is to generate as much passive loss, or earlier we defined it as depreciation, and at the same time, as much as excuse me, as much passive income as possible. You kind of want those two. You kind of want to maximize those two because they work with each other. They synergize. And at the end of the day, it's it's less tax burden. So that means more money in your pocket. That's really what it comes down to. I mean, you know, we talk to a lot of high income earners, a lot of, Sean, you have a lot of former colleagues are in high tech. And it's like, they have a ton of, active income, and not maybe not so much exposure to real estate, the more passive stuff. But we've been helping them, showing them how, by maximizing both the passive loss, the depreciation, and the passive income side of their, overall portfolio, they're going to end up, in a lower tax bracket, right? They're going to pay less taxes and going to end up being able to keep more versus not doing this. And uh, one obvious strategy that we can offer is by investing in our impact fund, where you receive a sizable amount of bonus depreciation, and then you marry it with our preferred income fund, where you're receiving consistent monthly cash flow uh, within a month of investing, and you enjoy the benefits of both right away.
Yeah, that makes a lot of sense, Joe. And thanks for outlining that strategy. I do want to reiterate, just from my own personal experience, I have a large network of friends who are from tech, lived in, the Bay Area for, almost 12 years. And a lot of them don't understand this strategy. And when, when they said they wanted to learn more and we sat down and kind of explained to them that they really don't have any passive income to be able to take advantage of these real estate tax strategies, within a few years, several of them, I have probably about a couple dozen friends now who have actually created new income streams by investing in syndications, real estate funds, or some of them had rental properties. And they're now just looking for ways to find that depreciation benefit. And they're significantly saving thousands of dollars on their on paying less taxes and eliminating 60-70% of the taxes they were paying because they're able to the synergies that you spoke about. They've created that system, which is a cycle. And for those of you who don't know myself personally, I run these cycles myself. Joe's been doing this for many years, and Adam talks to a lot of investors who deploy these strategies over and over to build generational wealth. So this is really exciting stuff if you really understand how it works. So with that, Joe, maybe we can walk through. We created this slide to really make it practical so that you can, really feel and, look at this and understand what we're saying. And Joe, I'd like for us to walk through, this, and explain to the audience like how these two work streams, these work together and the synergies between them to create that savings that we're talking about.
Yeah, for sure. So before I start, don't, the audience shouldn't, don't worry too much about these numbers. They don't really mean anything. It just, we're just doing these, it's just a hypothetical illustration. Um, if you look at the top, the top portion, if you invest $500,000 in our preferred income fund that I mentioned earlier, you would be receiving an 8% annualized return. Okay, and so what that comes out to is $40,000 per year. But if you did not have depreciation benefits, you would then, assuming you had to pay a 30%, if you're in the 30% tax income bracket, you would have to pay 30% on the $40,000 of income that you receive. And so you would have to pay the government $12,000 in taxes, and you would only net $28,000 in your pocket. Now, if you were to say invest $150,000 in our impact fund, where you are going to be receiving 60%, up to 60% of your investment dollars in bonus depreciation, which means uh, 60% of $150,000, you will be receiving $90,000 in a passive loss in the first year, and that can actually offset the $40,000 that you receive in the preferred income fund, and therefore you don't pay tax. You get to keep all $40,000, and you still have another $50,000 left over uh, for next year's distributions from the preferred income fund, or other whatever other real estate funds, um, passive syndications that you might have.
Joe, this 500,000 is just a very basic example, but somebody could have invested $500,000 in a rental property, right? That's actually generating
Yeah,
this some 8%, 5%, 6%, whatever their rental income is. It's the same thing. We just gave this as an example, but it,
I mean, like most of us, active investors, I mean, we use the words, real estate syndications interchangeably because most of us have both, we own both or we invest in both. So yes, yeah, you can definitely, if someone has a portfolio, of rental real estate already, well then, they can invest in just the impact fund just to generate, more depreciation, because they're probably not doing cost segregation on their own. They should, but uh, or vice versa, right? Somebody who has a lot of depreciation but doesn't have enough passive income, well then maybe then they would want to invest more in the preferred income fund to use use those use off the depreciations that they have accumulated.
got it. So that 90,000 in this example. So if in year one, if we offset the 40,000, we have another 50,000 to use. So what a lot of our other investors do is the next year they'll go invest, take another $100,000. They're making income, right? They made maybe a couple $100,000 in the year. They have $100,000. They go invest that $100,000 into something else, and they use that remaining $50,000 to offset that, new investment. And it's a cycle. And then, and people continue to kind of play the cycle out, which is it's pretty interesting. And we do it ourselves. So,
Yeah, I think when when you start when you extrapolate, every time you invest more, reinvest, you generate more passive losses, and then you invest in more deals, you have more passive income. And again, those two, they really synergize. And you'll see that at the end of the day, there's a lot less leaving your pocket. There's a lot less going to the government. So you're compounding out of at a ever increasing base, right? And mathematically, you just know that your pie is going to grow a lot faster.
Exactly. And again, I think one of the things that we try to we've all realized, at least a lot of the investors who are investing in real estate and even other, in other real estate or, investment vehicles, it really doesn't matter how much you're earning. What really matters is how much of it you can keep. And these are strategies to help really keep as much of your money as possible and not give it away to Uncle Sam. So thanks, Joe, for explaining that. Uh, so let's jump on to our next topic here. So can we perform cost segregation studies on our own rental properties to create this accelerated depreciation effect? I think we talked about it a little bit, but we just want to make sure that this audience understands that. And of course, the answer is yes. And I'd love to give this one, to Adam to really just kind of touch on really quickly, and then we'll go to some of the more interesting tips that we have.
Yeah, Sean, you already answered the question. Yes, and I would take it even a step further that it's a yes, and I would encourage you to do this if you do own a rental property. We a lot of CPAs are so used to that 27.5 year straight line depreciation that you can use to offset your passive gains. But as we touched on earlier today, that you do this cost segregation study, that 3.6% becomes 35% year one that you can use to offset your passive income. So not only is the answer yes, but something I would highly encourage you to do on any rental property you currently have. Do the segregation study, be able to take that much year one, and you're going to be much better off if you do this tax benefit for your property.
Absolutely. And, personally, I think over time, what I realized is just, I don't want to be, I've done a couple of these, we've had friends who've done a couple of these, but over time I realized I just don't want to be a landlord anymore. And this is the beautiful thing about syndications is the operator is buying these properties for you. They're managing them for you. You own a portion of that property, but they take care of all of the cost segregation studies and the depreciation aspects of it. And they're just hand over that benefit to you, which you then just give to your CPA, and you apply to he'll apply that to your income. So that's kind of the my realization over time is I've moved away from kind of I've reduced my portfolio of rental properties, and I've been kind of diverting more of my investing into syndications. But everybody has these are all options, so there's no right or wrong here. It's whatever you feel comfortable with. So okay, so thank you, Adam, for that. I think the next thing is, Joe, can you talk to the audience a little bit about how they can benefit from a cash out refi?
Yeah. In subsequent slides, we'll get into the 1031 exchanges, but uh, another really great way to uh perform a tax-free transaction or to minimize that taxable impact is to simply just refinance out the equity in your portfolio rather than selling it, or rather than trying to force an exchange. Again, we'll talk about that later, how difficult they can be at times. But you can simply, as your properties have appreciated over time, if you're receiving higher rental income, it's worth more money. You could simply just refinance out the equity, and then that transaction in and of itself is non-taxable, right? So you don't have to worry about tax, and you would just simply take the cash, take the equity that you pulled out, and invest passively in a variety of syndications. And I mean, think of it like this. If you're, if you, if you're able to get like a 4% mortgage, and you're reinvesting those proceeds at, like, let's say 15%, you're pocketing a 11% difference on the bank's money. So that's what they do. Why don't we just imitate what they do, what they're good at, making that spread?
Very, very, very interesting and very neat stuff. Awesome. And we personally know a lot of investors who use this strategy as well. They just, once they've increased their rents, they maybe purchased. Joe, you and I were talking about, some situations where even you yourself, have increased rents on some property by $300-400, and you've built, a certain amount of equity where you can just pull that out and then reinvesting it back into, into other investments that are giving you, higher yield. And that spread is your earnings, your profit, and and it works. And there's a lot of savvy investors, and just people who are, kind of leveraging these strategies. Okay, so let's move on to the next question here. So we get this question a lot. We have tons of investors who want to do 1031 exchanges into our BODC fund, into our, one of our funds. And so let's talk a little bit about 1031 exchanges and how our audience can potentially benefit from doing those. Additionally, I think, Joe, this one will probably go to you because, you tend to, this is a topic that's, I know, near to your heart. There's also something called a lazy 1031 and a traditional 1031. Both are things that we can, are avenues that investors, potentially selling their properties can use to reinvest in other, but kind of break it down for us a little bit in terms of what's the benefit of one over the other, and, and give us a little bit of the nuts and bolts of this.
Yeah, I get asked about this almost every day, and before I joined the team a couple years ago, I have personally approached Gary, asking him if I can 1031, some of my own de deals into his stuff, and the truth is, um, or I should just say yes, the short answer is yes, Break of Day Capital can and is willing to accommodate 1031 exchanges, if all the stars are aligned. You got to find an appropriate partner. The timing has to be perfect. The person that wants to come in alongside us, has to be agreeable to a tenants in commons legal structure and qualify for the loan and various pros and cons that come with that. The reality is, I mean, when was the last time we did a deal, guys? 7, 8 months ago? And before that, what was that? 14 months, right? So, Gary always says, we're not interested in doing deals just for the sake of more units, right? They have to make sense. There has to be something there has to be a situation where we can create value, and we're very, picky in what we go after. And so, you know, we it's very difficult, is what I'm trying to say, is to, for everything to sync up, right? But having said that, um, if the timing is right, we can certainly accommodate. I also want to take this opportunity to share with you, sometimes CPAs refer to as a lazy 1031, was actually a really great option. And it works something like this. Let's say in 2024, you're going to be selling a property, and rather than forcing yourself in doing a 1031 and a traditional 1031. And let me take a second to kind of talk about the cons of it, which is, you have, from the day that you sell your property, you have 45 days to identify the exchange property. You can identify up to five, and you then have 180 days to close, right? So you're under the gun to find something, and if you sold your property for a good deal, chances are you're going to be paying a lot more for the next deal. It's just Murphy's Law, right? Um, but rather than being forced into a time constraint, you can try this lazy 1031, where as long as you reinvest the proceeds, and we can get into the math, the appropriate amounts, into a future deal, whether it's another real estate, another like kind property, into one of our syndications, into our fund, um, you could take the cost segregation study, the bonus appreciation that we generate from investing in one of our future deals, and using that to offset the capital gains tax that you triggered by selling out one of your properties. And as long as you do this, as long as you perform both of these transactions within the same taxable year, so as long as you, for example, if you're going to do it this year, as long as you invest in one of our deals or on another operator's deals within the same year, you can get the benefits of a 1031, but you have a whole year to do it. I hope that makes sense.
Yeah, that makes a lot of sense. And I think one of the important things that I've realized in my journey over the last, 7 or 8 years, especially when it comes to 1031 exchanges, I've done a couple, is that the lazy 1031, you just want to make sure that your CPA understands the mechanics of it. Some of them just they've never done them or they just don't have enough knowledge. And you want to kind of move to, a CPA who does understand the nuts and bolts of how to really make it work, because then they can really just help you. It's just a math calculation, and it's a pretty simple thing. Once we give you a once we give you your K1 at the end of the year, any CPA should really be able to handle what we're calling this lazy 1031. Um, okay, so I know we said we would take questions at the end, but we do have somebody asking a question, and I think we'll go ahead and just answer this question. What's the minimum to invest in the preferred income fund? Um, well, actually, we haven't gotten into that, so maybe let's just wait till the end. With that, I think we're done with our Q&A session part of this. So thank you, Adam and Joe. This was super informative, and we've answered several of the questions along the way. So thank you all for adding your questions in. With that, I'm going to hand it over to Adam, and he's going to just wrap up a few more slides on some of our offerings, and then wrap it up, and then we'll open it up for Q&A. Back over to you, Adam.
Thanks, Sean. So right now at Break of Day Capital, we have two investment opportunities. On the left side of the screen, you can see the Break of Day Capital Preferred Income Fund. Now, this is a great opportunity for people who are looking for steady cash flow, monthly distributions, or need a place to put money between deals. In this preferred income fund, investors get an 8% return with monthly distributions, or they can opt to have their dividend reinvested. If they opt for the dividend reinvestment, the return goes up to 8.3%. What I really love about this fund is the redemption period. Now, as I mentioned before, Joe and I have Wall Street backgrounds, and I can tell you a lot of the hedge funds out there, when you want to take your money out, it can be a headache. They give you a very narrow window, usually into December, and then if you request your money back, it could take months. Now, in this fund, if you do want your money back, after your money's been in the fund for 90 days, the first week of every month, you can request to have your money returned to you. And if you request your money's returned to you within 45 days. Now, the last point we make here too is, while you don't get bonus appreciation if you invest in this fund, you can use bonus appreciation or any depreciation to offset taxes you get on those returns, because this is a real estate fund. So that 8% return, you can shield that through depreciation that you currently have or in a future deal as well. And while that 8% may not seem as high as some of these other numbers we'll talk about when I get into the impact fund, that 8% return is significantly higher than what you're getting right now in a money market account, a CD, as well. And one thing I think people investors need to be reminded, if they have money sitting on the sidelines right now, that for mid to high 4% they might be getting a money market account. When the Fed starts cutting, that's going to go sharply lower. And it's not proportional either. If the Fed cuts 25 basis points, your return is not going to go down just 25 basis points. It may go down 50, 75 basis points. So the multifamily impact fund. Now, this fund, if you invest in it, your money's going to be diversified over several properties. And your money's going to be diversified based off the capital raise. So if there's, we already have one deal in this fund, Spanish Trust, and I've spoken to many about that deal. And let's say we have two additional deals in that fund. If the capital raises was all the same amount, your money's going to be would be diversified a third, a third, a third over each deal. Now, in this fund, your investment is long term. Once your money's in this fund, it's in the fund. You get your money back as each deal goes full cycle. Now, the returns we're targeting for this fund are significantly higher. For the deals in this fund, we're going to be targeting a 1.7 to about 2.2 times equity multiple. We're targeting an average annual return of anywhere from 20 to 22%. And an inflation-adjusted return, the IRR, the internal rate of return, of mid to high teens, 16 to 18% for this fund. Most deals we hold for 3 to 5 years. Now, it's also, since we spoke all about tax benefits, deals in this fund will give you bonus appreciation. So you will get the big tax benefits for this fund. Now, I know I'm going over this rather quickly, but would love to go over this in much more details with each of you if you have any questions on them. We go to the next slide, Sean. I'm going to if you would like to go over our investment opportunities in further detail, on the left side, you can see under my picture and title, you can email me at adam@breakofdaycapital.com, and my number there as well, 602-529-2056. You can email me, call me to set up a time to talk. We can definitely book a video call. And I also highly recommend you scan that QR code on the screen. That'll take you to our investor portal where you see all of our documents. And I know we're going to open this up to questions and answers. So as I said before, please ask questions. We're here to answer them. There are no silly questions. There are no stupid questions. There are only questions. And any question you're asking, I guarantee somebody else is thinking about it as well. So please go ahead and ask. And lastly, I encourage you to follow us on social media as well. We're on Instagram, Facebook, and also on LinkedIn. You're welcome to connect with any of us on LinkedIn as well.
Awesome. Thank you, Adam and Joe, for wrapping that up so nicely. We do have one question, pretty straightforward. So what is the minimum investment for the preferred income fund? So our minimum investment on pretty much all of our offerings is 100,000. But if there's certain situations where you really want to get in on a case-by-case basis, we have made some exceptions. So just definitely talk to either one of us, or you talk to Adam, and he'll help you figure that out. So we do make exceptions now and then. Any other questions? Okay, so we have another question. So what was the main difference between the preferred income fund and the impact fund in terms of timelines? So again, this is just a really straightforward answer. So the preferred income fund, in terms of, so I think they're asking about in terms of redemption, in terms of if they need to pull their capital back out. The preferred income fund, which has that fixed 8% annual return paid monthly, that's a 45-day, within 45 days, you can expect your funds returned. Just have to request that at the beginning of the first week of each month. And again, I'll say that you can shop around and you'll see that most funds and offerings out there do not give you this type of redemption. The redemption is usually a year at best, and then usually it's a 3 to 5 year hold. And we have those offerings too, and that's because that money is being invested in in capital, improvements, and that money's tied up. So it's really hard to have that money be liquid. But because this preferred income fund is investing in what we call the preferred tranche of other investments, it allows us to be a lot more liquid. And we've created this just for investors who are looking to be able to have something that's much better than your typical 5% that you're getting in money markets, but something that is also liquid, so that if you're in between deals or you're waiting for some big thing to happen in a year or so, you can park your money here, earn a nice 8% return, and then pull your money out when you need it. So we've tried to create that convenience for our investors. Anything to add on that, Adam or Joe, on that point?
Yeah. So just to finish up on the preferred income fund, it is an evergreen fund, meaning that we expect this fund to be open forever. Provided that there are viable deals that we want to invest in. But again, the big thing that Sean pointed out already is that within a 45-day written notice, you can have your funds back in full. So that's a really great way to be able to come in and out. Um, as far as the impact fund goes, that is a closed-ended fund, meaning that at some point in the near future, when we have satisfied the diversification part of the strategy, where we're looking to acquire up to 3 to 5 assets, we're going to close the fund. And so I don't know the exact date. We have a couple of extension periods, but you can reach out to Adam if you need the specifics. Make sure you get your money in there. But the way that that fund works is we would you know after some time, we're just going to arrive with what we end up with, whether it's 2 assets or 5 assets. And then as we exit those properties, the investors will get back their capital and the proportional share of the profits as they come due. We're not going to be reinvesting the proceeds. You're just going to get the benefits as soon as we take it to fruition. And I think that's the main, and I should mention that the life cycle, the expected hold period for the impact fund is more like 3 to 5 years, because it does take time to execute on our value add strategy. So that's I think that covers it. I don't know if you
Awesome.
want to add anything there, Adam.
No, I think you covered the everything about the impact fund. But one point I do want to stress about the preferred income fund too is, you know, it's a great place to sort of plant money. And I think that's what a lot of investors are looking to do with us. You're just saying, I don't want my money in a money market account. I want to get a much better return. So they're saying, you know what, this preferred income fund's a great place. I'll take that 8% return, especially if I can use, the tax benefits down the road to avoid any ordinary income taxes on that 8%. And then are opting, if we have the next deal to say, hey, if this deal looks great, to say, you know what, let me put my money from this preferred income fund in the next deal or the impact fund. They're going to have those two choices when the next deal comes along.
Yep. Thank you for answering that question, team. So Karen asks, does the bonus depreciation tax benefit depend on when I invest? For example, if the syndication is in year 2 versus year 1? It's a good question.
You want me to take that one?
Yeah, go
Hey, Joe,
ahead.
why don't you take that one?
Oh, you want to take that one, Adam?
No, I said, Joe, why don't you take that one? I know you
Oh,
like
okay.
this is it. I know how much you
Okay.
love these questions.
Yeah, it matters it matters when you invest because it has to do with whether we have a deal at that time, and also uh there's two moving pieces. When we're buying deals and when your money comes in. In the first year, you're going to be able to receive the most amount of bonus depreciation that's available. We're going to try to get as close to the theoretical limit as much as possible. However, um, if you were to come in the second year and we don't have a new deal, assuming that actually doesn't even make any sense because we wouldn't be raising more capital if we don't have another deal. But yeah, what you should really take away with is that in the year that you're entering, whatever the theoretical limit is for the bonus depreciation, that is that's the number that you should think about in terms of a percentage of your investment dollars. So last year, just by way of example, the seed investment in the impact fund was Spanish Trail, and last year in 2023, the theoretical limit was we were able to offer up to 80% of your investment dollars in uh, in bonus depreciation. But I think after we did our study, we were only get up to what was the final number, Adam? It was like around 71%.
I was gonna say right around
So
70s.
Yeah, so on $100,000 investment, you would be able to show about a $71,000 loss on your K1. And for this year, if you're coming in this year for like let's say in our next deal, the theoretical limit would then be $60,000 on $100,000 investment.
Yeah. And so what kind of like the point here is when we're raising funds for you to invest for any investor invest in syndication, we collect money until we can, until when we're done raising funds, that's closed off, and we don't raise any more funds for that particular syndication. So after that certain amount of time, there would be no even, question of an investor investing in a deal that's already been closed. So that typically happens, within the 5 to 6 month period that we're raising funds. And once that's closed out, once that raise is done, it's done. So there's but the impact fund has the opportunity for people to come in every time we have a new deal. That's when it opens up again for investors to come in and be a part of that next deal. And again, we're only planning on doing 3 to 4 properties in that impact fund that Adam and Joe were speaking about. That's the what you're seeing on the screen. That's the column on the right is what we're talking about right now. Like somebody's asking again, what's the minimum investment? So again, the minimum investment for the preferred income fund is 100,000. It's the same for the multifamily impact fund. Both are 100,000. And again, we do make exceptions if, depending on what the circumstances are. All right. Any other questions? Looks like we're right on time. Excellent. So I think, well, let me give it one more minute. Let's give it one more minute. So don't be shy. We still have a few more minutes planned for this session. So if you have any more thoughts, questions, just feel free to drop them in. And if we don't see anything pop up in the next, 20, 30 seconds here, we'll go ahead and wrap it up. Uh, we're going to send the recording out. This has been recorded, so you'll definitely get this. You can go back and refer to, we know this is a very dry topic and there's a lot of details here that you have to review 2 or 3 times to actually, kind of pick up on what the message is. And, feel free to, again, Adam provided all of his contact details. You can reach out to any of us. We're always here to answer any questions. And with that, I think we'll go ahead and end the recording. Let me just go ahead and do that.
Did a question just come
Wait,
in?
actually, we just got a question come in. Okay. So would it be smarter to wait and see if Trump gets in? And let's see, let me answer this question. What's the full question? Oh, it just cut off there. So would it be smarter to wait and see if Trump gets in? And there's a second part to that, but that I don't think they finished typing. So Lauren, you said,
I can take this one, Sean,
go ahead,
and if you guys want to add anything to it, because I know I believe this question relates to the bonus depreciation
yeah.
and cost segregation, as you guys alluded to, the topic that I'm very passionate about. Um, so think of it like this. Regardless of who gets into office in November, we already have cost segregation in place, right? That's not going away ever. Okay. I mean, as far as I know, right? Never been, as far as I know, cost segregation has been around forever. So at the very minimum, we know that you can still do cost segregation. So that means that still could potentially write off up to 30 to 35% of your investment dollars, or I should say the depreciable amount, um, regardless of who gets into office, right? And we also still have currently in place the rest of the bonus depreciation schedule, which as Adam alluded to earlier, if started at 100, we're now at 60% for 2024. And then in 2025, it'll go down to 40 and then 20% in 2026. So assuming no changes, assuming Congress does not reinstate bonus depreciation up to 100%, you already have very aggressive depreciation um, tactic, in place, so to speak, and it can only get better, right? So again, as important as depreciation is, as important as tax deferment is, if there's a really good deal, today or next week, we're gonna buy it. Like it's not, we as much as we try to time the markets, wait for certain events to happen, what if they don't happen? We have to be able to operate successfully in all market conditions, right? And so that's my long-winded way of saying that, it's difficult to foretell the future, and so we do the best we can with the information we have today.
Yep, and Lawrence actually wrote again saying yes, and then and then we might get that 100% bonus depreciation if he's alluding to if Trump gets. So thank you for Joe for addressing that question. I think we answered that one. Um, Hannah has a question. How can you calculate how much passive losses would be needed to offset passive income when choosing investments?
Yeah. All right. Same thing here. So I'm gonna answer this a couple different ways. First of all, um, if you're looking at overall, you'll have to see, first of all, you have to see what your accountant, what your CPA has uh have accumulated in your depreciation bucket. I'm not exactly sure what form that is on. You can always ask. It might even be categorized as net operating loss. So just figure out what it is, and from there you can always offset future passive income from your loss bucket. And that's actually a good point too, is that if you cannot use the passive loss today, you don't lose it. It gets carried forward into future years, so one, you want to see how much losses you already have accumulated, okay? And let's say you didn't have any of that. Let's say you're a newbie investor. Probably the quickest back of the envelope calculation is to just multiply by 60%. If you're looking at $100,000 in capital gains or passive gains, then you need um, then you need to adjust for um, how much losses that you need to generate in in future investments to offset, right? So we know that for every $100,000 in future investments, you can write off 60,000, right? So you just do the math. What was it? Do you just take the 100 divided by, was it zero point 0.6, and you get the number that the actual dollars that you need to invest to offset the whole thing. So that's the calculation. I don't know if you guys want to check my math on that, Adam or Sean, but I
No,
think you take
that's
the,
it.
It's good.
that
Yeah.
sounds about right. Yeah.
Sounds about right. And it's really just working backwards. What I do is, and I've do this, I've been doing this for several years. I know Joe's been doing it for years, Adam, as well. What I do is I work with my CPA, and you really got to have, this is where you got to have a good, a CPA that you can work with, who's willing to answer questions and who you can kind of engage with and figure out how much am I going to be earning in passive income. Because once I understand how much I'm earning in passive income, then I know how much depreciation I need to generate, how much investment I need to make in a certain asset with that, whether it's 60% or 80%, when you do the bonus depreciation and you kind of do that math, I figure out how much I need to be making to offset my full passive income. And in our case, some of us are real estate professionals, so it becomes full active income, and we're going to be talking about that in the session too, in a couple of weeks. But hopefully that answers your question. And then we hope, hopefully that answers the question, but feel free to reach out to us and we're happy to dive into this a little bit more individually with you. Lawrence asked, would it be smarter to wait and, oh, sorry, this question is done. We've gone through all the questions. That was a duplicate question. Any other questions?
Yeah, Sean, while we'll give them obviously we'll give people another minute if they have any questions to type in there. But going back to that one question somebody asked about, should I wait or get into it? I mean, one way I always used to describe about, waiting for the perfect timing, and I'm sure Joe can relate to this too, was, well, we'll go back to your former employer, Sean, Google. When the IPO came, I remember talking to people about the stock, and they said, no, it's too expensive at 200. The next thing you know, it was like 300. Too expensive. I didn't touch it. It became 500 and kept on going up and up and up. And as Joe touched upon, there's never a perfect time. And as Joe also mentioned too about we know where it is now. That 60% bonus appreciation is a huge number by any stretch of the imagination. To reinstate 100%, it may go retroactive as well. You may be able to get it if you invest this year. So I would not let that be a limiting factor into you trying to time the investment. If you see a deal you like, certainly I would invest in and not have to try to market time it 100% because nobody ever does. Warren Buffett even talks about that if he likes a company, he buys it. Trying to wait for the absolute bottom never works.
By the way, in terms of timing, let's say hypothetically you invested today, right? And you know that you will get 60% of your up to 60% of your investment dollars in bonus depreciation. Now, we're not going to issue 2024 K1s until probably like sometime in mid-March. And that means you got a lot of time for Congress to potentially reinstate the bonus depreciation back to 100%. And so by the time that we get to file, we'll actually end up doing 100% anyway. So it's you know
Hopefully. Yeah.
yeah, that's hypothetically speaking.
Yep.
But
Awesome.
yeah, I feel like before we jump off, I just you know this is a topic that's a little dry and it could be kind of technical and monotonous, but it's very important, that it's one of the best things about real estate investing. And I've personally benefited for many years, and right, Sean and I, we've had, and Adam as well. We've had so many private, you know, conversations about this, and I think Sean, you're starting to see the benefits of, how depreciation can really supercharge, your income, or I should say your what you get to keep in your pocket, right? Because as we mentioned earlier, it's not what you make, it's what you get to keep at the end of the day. And the more that you can do that, the more you're compounding your wealth at a much higher rate. You don't have to take on more risk. You don't have to take on stupid leverage. Like, just use the tax benefits that are given to us.
Yeah, that's really well said. And I think that's a great point to end it on. I think we've had a lot of great questions. If we don't see anything else pop up, I'm going to go ahead and wrap up this call. Again, to the audience, it was really a pleasure having you all. Thank you for taking the time out of your busy schedules to join us. And we look forward to answering any questions you have, any follow-ups. Adam and Joe are available. I'm available. Thank you all so much for joining us and have a great rest of the evening. See you, everyone.
Thanks, guys.
Thank you.